Hi everyone, I'm Paul and welcome to my review of ICT's 2022 YouTube Mentorship Program for Lesson 16. Today's video answers the question of how to take multiple setups in a trading session using the concepts that ICT has been teaching in his YouTube Mentorship Program. This is really helpful because sometimes you might miss that first setup in the trading session, or perhaps other opportunities present themselves later in the subsequent trading session. So today's video is going to help us unlock as much value out of that trading session as we can get using the concepts that ICT has been teaching in the YouTube Mentorship. So please like and subscribe, and let's jump into today's video. Today's video is lesson 16 in ICT's 2022 YouTube Mentorship Program. And so we'll just briefly cover the outline for today's video. So first of all, we'll be covering understanding the importance of time. And secondly, we'll be looking at how the time of day provides the opportunity for multiple setups. And finally, we'll look at some examples of ICT's trading concepts using the ES or the S&P as an example from the 1st of April. So understanding the importance of time. So one of the significant themes in ICT's teachings is that time is a central concept. And whilst ICT's YouTube mentorship focuses mostly on the New York session, ICT prioritizes other specific sessions across the trading spectrum. So he calls these his ICT kill zones, and they are across Asia, London, and New York. And as I mentioned, the New York session is the one that he focuses on mainly in the YouTube Mentorship Program. And the reason ICT focuses on the New York Open specifically is because it has the most reliable setups and it's the easiest to learn for new traders. And so within this New York trading session, ICT delineates two specific parts of the session, both the morning session and the afternoon session, with no trading during the lunch period. So the morning session goes from 8:30 to midday, and the afternoon session goes from 1 o'clock to 4:30. So there's no trading in that lunch period, so there's two distinct periods to trade in that New York session. And so the primary reason why we focus on either specific sessions or specific times within a session, if we're looking at New York, is because this significantly changes the reliability of the setups that ICT teaches in his YouTube mentorship program. And so because of the focus on time, this allows multiple opportunities for setups within the session. So obviously, if we're looking at both a morning and an afternoon session, we can be taking trades in the morning and in the afternoon, so hence there's multiple opportunities, or we can be taking multiple opportunities just within one specific part of the session. So for example, you might take multiple setups only in the morning session. So there's two distinct ways to generate multiple trading opportunities from the specific times of the day. So we'll start with our daily chart on the S&P or the ES. So we use the daily chart to determine our bias. And so if we look at the chart here, you can see from the 15th of March right up until about the 29th of March, the market was on this really strong uptrend, and you can see we've broken through the buy side liquidity at these highs here before breaking through these relative equal highs here. Now at this point here we have a swing high. So remember, a swing high is when you have the high of the middle candle higher than the high of the two candles either side. So you can see that is the pattern that we've formed here. And then this candle here, which is this strong down close candle, has then started to trade down into this bullish order block down here. Now, one of the things that is always a little bit of a challenge when you start to apply ICT's concepts is as we've broken into the liquidity here, so in this move here, we've taken out this buy side liquidity. One of the questions is well, how do we know that that move is going to continue to the upside, or how do we know that that's just going to be a liquidity grab and the market is going to then pull back? So you can see in this first move into this buy side liquidity here, we have these up close candles and we don't get a swing high painted. So we don't have that situation where the high of one of the candles is higher than the two candles either side of it. You can see in this particular move, we just get consecutive up close candles. And even in this candle here, which is a down close candle, you can see that the high of that candle is still higher than this one. So this would indicate to us that this move is going to continue once we've breached this buy side liquidity here. Now in this particular move, you can see similarly, we've broken through that, we've taken out that buy side liquidity, and we have actually painted a swing high here. So you can see the high of this candle is higher than the high of these two candles. But the difference is this next candle here is quite a strong up close candle. So that would tell us right away that we'd expect this move on probability keep going higher. Where in this case, on this particular example, we have relative equal highs as well as this buy side liquidity resting above these levels here. We have our swing high, but this next candle is a down close candle. And so that increases the probabilities then that the market is going to keep trading downwards. And so we're going to be looking for lower prices. Now in this particular setup, you can see this candle has traded down into this bullish order block. So this is our order block here on this down close candle. So this is a down close candle before this move, and you can see we've got an imbalance here. So that's part of the requirements for an order block, is to have the order block prior to an imbalance. And so with this down close candle on the 1st of April, we'd have the expectation that it's going to not only be a down close candle, that it's going to trade down into this bullish order block. So remember, when we're trying to determine our bias, we're always thinking about where is liquidity going to draw, and liquidity is going to draw either to highs or old lows, or into imbalances or into order blocks. And so in this example, that's what we're looking at. We have this down close candle and it's reaching down into this order block here, trying to take out that liquidity there. So just some other things to note on this particular chart is this down close candle here. You can see it's quite a powerful down close candle. This is a really good example of the power of three that ICT teaches in his mentorship program. So the power of three is basically accumulation, manipulation, and distribution. And that helps us to understand the formation of this candle. So we have accumulation at the open and into the highs. We have manipulation where the price is pushed higher before it's driven downwards again, and then we have distribution at the low and the close. Now I won't go any more into the power of three in this particular video because we're focusing just on multiple setups within the trading session. So let's look into our hourly chart now and start to apply our bias to that particular time frame. So zooming in now to our 1 hour chart, remember the thing that we're looking for is where is price going to draw to, is where is that liquidity going to reside. So the thing that immediately jumps out on the chart is this sell side liquidity, relative equal lows we have down here. Now obviously these lows aren't exactly the same, and that's why they're called relative equal lows. So we know that there's going to be liquidity residing below these levels, and we also have this bullish order block from our daily charts. This is transposed from our daily onto our hourly chart, and we know that liquidity is going to be resting there as well. So having both this sell side liquidity, relative equal lows, and bullish order block just increases the probability that price is going to draw down into that level and seek that liquidity. So the confluence of these two occurrences increases the probability that price is going to draw down into that level. And so from the midnight open, so remember ICT has two opens, he has the 8:30 open and the midnight open. And so from midnight, you can see I have delineated that by this green line here. The market immediately starts to trade higher above that level, and so this is what we want to see. So when we have a bearish bias, we want to see price trading above a key level, so in this case above the daily open or the midnight open price, and this is that manipulation from the power of three that we talked about before. So this is what we want to see. We want to see this Judah swing, so this is a trading higher before the market trades lower into the session. And you also need to remember, and this is really relating back to our daily chart, is that because we've traded above old highs, so remember those relative equal highs from our daily chart, is that we're actually in a premium market. And so when we're going short, we always want to be in that premium market because that's the ideal place to position ourselves for a short setup. And so as we look at our 1 hour chart, our first target would be this sell side liquidity just here. And then our next targets are going to be the sell side liquidity, relative equal lows down here, and then finally our bullish order block down here. The other thing that's worth noting, you can see the imbalance that was created here from the previous session. The market's traded up into that. We haven't completely filled out that imbalance, but that's the kind of reaction that you would expect as we trade into this imbalance on the 1 hour chart, that we trade up into it, and then the market starts to peel away. So zooming into our 15-minute chart now, there's quite a lot going on here, so I'll just quickly review what we're looking at before we start to move into the setups. So this is that move that we were looking at on the 1 hourly chart, where the market trades higher, and we have our opening price here from the first. Market trades higher up into that. Now, This is that imbalance from the 1 hour chart that we were looking at before. This bearish imbalance, which the market trades up into. We have the sell side liquidity that was formed here from that stab downwards. And then we have our sell side liquidity relative equal lows over here, which we extend out, and our bullish order block from the daily down here. So that's the lay of the land for where our chart is. And now we can start to layer on top of this some of the additional teachings that ICT covers in the video. So the first thing we'll look at is the fib retracement. Now ICT will put his fib from this point, which is the low of the move, to the high. Now he excludes the wicks and just looks at the body. So if we put that on now, you can see this level here. So this is our midpoint just here, and the bottom and the top of the fib, and you can see they're anchored on the bodies of those candles here. Now this is just another measure to help us start to build confluence, and also to help us build some targeting into our system. So by putting this fib on here, you can see we have these two fib levels here and here. And interestingly, this is obviously all backwards looking, but you can see that this fib level here coincides very precisely with the low of that candle here. So that's the low of this entire move is targeted by this fib here. So the accuracy of this is quite high, and you can see we now have confluence, because remember, we wouldn't actually have this price action here because we'd only be looking at this section of price action here. So we'd only actually have this section of price action here. So all this would be clear, and so this would just add confluence to where we think price would go, because remember, we have a bearish bias, so we're expecting lower prices. We know we have relative equal lows down here, we have a bullish order block down here, and now on top of that we have a target from our fib which coincides with all these levels. So this just builds that confluence that we're expecting lower prices. We obviously have this sell side liquidity here, and so that just adds more probability to the setup that we're trying to get into. So if we just clean up our chart just a little bit, we'll just take that imbalance off from the hourly, and you can see that we have this swing low just here, and so I'll mark this out. So we have this swing low here, which is broken by this particular move. So you can see we have this displacement lower. So this is where our fair value gap is formed just there. This move from here to here breaks market structure. So we break the low of that candle just here. And then you can see the market trades back up into it before trading lower. You can see it takes out this sell side liquidity before trading all the way down through these relative equal lows into the bullish order block. You can see it goes through the level of the top of that bullish order block and tags with, very high precision the fib marking just here. Now in terms of managing this particular trade, you could obviously have entered here. So you would enter on the high of the third candle, and you would set your stop here at the high of that second candle. So you can use either the high of the first or the second candle. And then in terms of exits, you could use the first point on the fib as your first target. You can see that would give you a risk reward of about 4. And if we went right down to that second fib, and again that would be super precise, you can see we get a risk reward of almost 6. So if we just recap everything that we've covered to date, you can see how that we're creating a lot of confluence and we're building probabilities in our favor that this particular setup is going to be successful. So we go into our daily chart and we've determined that we have a bearish bias. Again, from our daily chart, we're in a premium market because we've taken out those old highs. So remember, we had the relative equal highs from the daily chart, which this particular move took out. So we know that we're in a premium market and we want to be going short in a premium market to maximize our chances of having a positive return. We know that as we zoomed in on both the hourly and then the 15-minute chart, is that we have liquidity resting at the relative equal lows and at the order block, that bullish order block from our daily chart. Then when we lay our fib over this particular piece of price action, we then create more confluence with our relative equal lows and bullish order block with this fib level just here. We then have the market trade above a key level. So we have the market trade above the midnight opening price. So we have that manipulation upwards, which is what we're looking for. We then get a fair value gap formed and a displacement occur, and then a break in market structure, this break of this swing low here. So we have a shift in market structure, the market trades back up into that imbalance before taking out the liquidity here, and then here, and then trading down to our second target here. So you can see once you start layering all of these different points on top of each other, you start dramatically increasing the probabilities that the trade will go in your favor, and you're also just adding more and more confluence to your hypothesis about where price will go. And in this case, we had a bearish bias going into this particular part of the session. So that setup on the 15-minute chart was a trade unto itself. You could see that if we use both the first and the second targets there in that particular setup, you can see we would have created a really great return from that trade opportunity. But this particular video is all about generating multiple opportunities from the same trading session. And so what we're going to do now is zoom into the lower time frames and show how that there's multiple opportunities to take advantage of that bias that we've drawn down from our daily chart into these lower time frame charts to uncover multiple opportunities within that particular move on the morning session, and then on the subsequent part of the trading session, the afternoon session as well. So our first entry on the 5-minute chart is just transposing the fair value gap from the 15-minute down onto the 5-minute chart. Now you can see that it doesn't perfectly set up. It's not as clean as it was on the 15-minute chart, but we don't actually need the market to trade up into the fair value gap on the 5-minute chart for it to be valid, because we know we have a valid setup on the 15-minute chart. So we don't need to see price trade up into the imbalance on the 5-minute chart for it to trigger an entry on the 5-minute chart. So it's not as clean, but this is a perfectly valid way of taking the same trade, but just on a different time frame. So again, if we zoom in now to our 1-minute chart, we can see if we transpose that fair value gap from the 15-minute chart across, we create another opportunity or another area of interest where we can start to look for entries. So there's actually another fair value gap that's been created on the 1-minute chart just here. And so we now have the situation where we have a 15-minute fair value gap and then a 1-minute fair value gap residing within it, and the market trades back up into it. Again, we go above that opening price before the market starts to trade lower. So that's another example of an opportunity, even within that same 15-minute fair value gap, where we have multiple opportunities and multiple ways to get set in our short trade. So our second opportunity for an entry, again on the 1-minute chart, resides below that opening price. So you can see we have this fair value gap that's been formed just here, and the market trades back up into that before starting to target that sell side liquidity just resting down here. So one of the ways that you could take advantage of this particular move, considering you've missed the initial one above the opening price, this is still quite a high probability move, because now we have quite a lot of confidence because the market's working in our favor. We've ticked off all of those points, increasing the probabilities from that section in the video on the 15-minute chart. So the way we could actually trade this position is we could take multiple contracts on this particular setup. You would take some of those contracts off the table once we take that initial sell side liquidity out, and then once we hit those relative equal lows or order blocks, you could close out the rest of your position there. So immediately after that second opportunity for an entry, we have another fair value gap that's created almost immediately after. So this is actually the move that goes back in and rebalances the fair value gap from the second entry, actually creates then a third opportunity to get into that position, and then the same rules would apply. You could go into this position, it's still quite a high probability trade. You would take multiple contracts, take some off the table at that initial sell side liquidity, and then take the remainder off at the order block, which is our target for this whole move. Now, our fourth opportunity for entry is the last one that we have before the lunch session. Now, remember, in lunch, we don't take trades during the lunch session, but we are actually able to close trades out during that session. So if the market moves into a favorable position for us during lunch, we're more than welcome to close trades out in that particular part of the session, but there's no new trades that should be entered during the lunch session. So again, the same guidance would apply as with the other two previous setups, is we take multiple contracts, target this initial sell side liquidity for some of those contracts, and then close out the balance at the order block from the daily chart. So you can see just in the morning session, and from that one particular setup on the 15-minute chart, we had multiple ways of entering it. So we could have entered on the 15-minute chart, we could have entered on the 5-minute chart, and then on the 1-minute chart, we had 4 opportunities to take advantage of that confluence that we'd built from that 15-minute chart, increasing the probabilities of successful trades throughout the session. And now finally, we look at the afternoon session. So obviously with a separate session, that creates a whole separate opportunity to be able to trade in that session, and then really to be able to maximize the amount of value that we take out of the trading session as a whole. Now, I won't be going through every single setup for the afternoon session, but just principally what we've had occur is the highs of the session from the morning session, so prior to lunch. Those highs are now the buy side liquidity, because remember that move down into the bullish order block is actually now completed. So we've actually achieved the target in terms of where we're expecting the market to move. And so now we're expecting price to go back up and start to seek this buy side liquidity from the morning session. So because the market's already reached its price objective, we're expecting a retracement back into this weekly range. So just remember, one of ICT's core teachings is that the market will reach for liquidity on the basis of time in preference to price. And so on this basis, we would expect that smart money has now reached their target. So they're now closing out their position. So they're going to be short covering, which means that they're going to be buying. So the market has now switched from having a bearish bias to now a bullish bias. And with a bullish bias, we're going to be seeking out that buy side liquidity, which we know is resting at the highs of the morning session, so prior to the lunchtime session. And so how this starts to set up is that we have relative equal lows, which are forming at that bullish order block from our daily chart. And this is where smart money is going to be starting to close those short positions. And so we're going to have buying happening at this sell side liquidity down here. And you can see on this 1 minute chart, so this is a screenshot from ICT's video, you can see this long setup here. So we have a bullish fair value gap formed just here, and you can see the market trades back into that before trading higher. And so the target from this particular move is that buy side liquidity from the highs generated prior to the lunch session. So as I mentioned before, there's now multiple setups, so multiple opportunities to get set in this session in the afternoon session. So we have multiple opportunities both in the morning session and now in the afternoon session from this one particular day on the S&P. I hope you enjoyed my review of lesson 16 of ICT's 2022 YouTube Mentorship Program. I know that a lot of people, including me, have been looking for ways that we can unlock more trading opportunities from a trading session using the strategies and techniques that ICT has been teaching in his YouTube Mentorship Program. So I think that today's video gives a really good insight into how we can do this, and hopefully this is something that you can apply to your trading going forward. If you enjoyed this video, it would be great if you could like it. That helps other people to find it. And if you enjoyed this video and you'd like to see more content like it, make sure you subscribe to my channel. Thanks for watching, and I'll see you in the next video.